computed or aggregated across the organization, or the inputs that go as a part of economic capital calculation models. How do I validate those models? How do I assess the counterparty risk, or how do I assess the interest rate risk involved in these kind of economic models? All these things we would try to understand, and of course apart from the practices that are there, we'll try to understand the various issues that are involved in the computation of economic capital through these mechanisms. So just to start off, I would like to identify, whenever we talk about a good risk measure, we have been using various terms like value at risk, expected shortfall. We also talk about tools like standard deviation or some kind of coherent risk measures. So whenever we talk about any good risk measure, we see that it should follow these particular rules. It should exhibit the behavior of monotonicity, which is nothing but, in the future, as the expectations of the returns are going to increase, if I expect that this particular security is going to be profitable in future, then the risk associated with it should come down. Means I'm having more and more positive expectations about the performance of the security in future, so the risk that would be involved in it will be much lower. That is a measure of monotonicity. Then we talk about a principle of subadditivity where probably if I am considering two securities A and B and I am combining them into a portfolio in some combination A plus B, the risk of individual assets versus the risk of the portfolio, if I am looking at these two things, the combination risk, whatever the risk measure is, I can talk about standard deviation, I can talk about VAR, whatever is the risk measure, the combination for a portfolio, the combined risk should be less than the sum of the individual independent risks. So that is the behavior of subadditivity. And the important point relating to the subadditivity is the VAR, value at risk. Value at risk does not exhibit the subadditivity kind of a phenomenon. Means there might be a possibility that the portfolio value at risk is higher than the sum of the two individual value at risks also. So that may not be a good risk measure from that dimension because it does not have a subadditivity kind of a principle. Then the third important thing we are looking at is the concept of positive homogeneity, which means as the size of the company is increasing, it tries to pose more and more higher risk. So the company or a portfolio, as the size is increasing, some kind of liquidity is, so the risk also should keep increasing with the size. And finally, we also talk about another feature of a good risk measure, which is called translation variance, wherein we say that whatever is the risk that is associated with a portfolio should be based on the assets that are formed as a part of the portfolio. So wherever I am talking about a value at risk of a portfolio or something, it should be purely based on the components of that particular portfolio itself. These, apart from these are the key properties that any good risk measure should satisfy. But apart from that, yeah, one, it should be intuitive. People should easily understand. I should be able to communicate it much better. I should be able to calculate it much better. and there should be a stability. Just one value change. It should not happen that the VAR has gone up drastically or any such risk measure has changed quite drastically. So there should be a lot of coherency and stability associated with that risk measure. And also the decomposition process, which means if I have computed this particular measure at my organization level, I've computed this measure at an organization level, and if I want to distribute it across my various departments on some basis, the distribution or the decomposition of the same should not be a big difficulty for me. Then if all these conditions are satisfied to a large extent, we call that particular measure as a good risk measure. It could be value at risk, it could be standard deviation, it could be a coherent or a spectral risk measure or expected shortfall, whatever it is. Now, the most common kinds of risk measures which we generally go with, we look out for a standard deviation, which is very easy to calculate kind of thing, right? A standard deviation is very easy to calculate, but it violates monotonicity because there might be a possibility that the returns are going to increase in future. If for a security, if the returns are going to increase in future, it may very well increase the risk also. It may not decrease the risk at all, because the deviation from the current numbers are going to be much higher. So the standard deviation can even go up. Because of that reason, the monotonicity is completely violated by standard deviation, and it is not stable because it depends heavily on the loss distribution. Almost all the risk measures have this limitation. Almost all the risk measures, they are very heavily dependent on the loss distribution, so they may not be so stable also. And but on the positive side, I'm seeing that standard deviation is easy to calculate. So probably as a base mechanism for assessing the risk, I can very well use this standard deviation measure. But when we talk about value at risk, of course, today the buzzword, right? People keep talking entirely about value at risk. There is a mechanism. We have discussed about the ways the value of risk is presented. 1% daily VAR is equal to 500 bucks, which means there is a 1% chance that on a daily basis my loss would be more than 500 bucks. So that is what is the way we are defining the value at risk. One positive side is, yeah, probably by now people became comfortable in terms of understanding the conceptual aspects of it. So wherever the absolute loss need to be mentioned, absolute risk, and not in terms of comparison purposes and all, wherever I would like to look at the absolute risk computation, people are using the VAR quite comfortably. But as I have informed earlier itself, it violates the sub-additivity kind of a principle. Means there is a possibility that a portfolio VAR could be much more than the sum of the independent securities value at risk. So that way the sub-additivity principle is getting violated with respect to VAR. Then when I am looking at the expected shortfall, even this has a problem with respect to stability. It may be dependent on the loss distribution itself. And the biggest problem is interpretation becomes very difficult. Because as a typical mechanism itself, if this is the VAR, expected shortfall talks about, okay, if this is your possible if the losses beyond this is what is your 5% VAR, then what is the expected loss in this? So the expectation, which is the weighted average probability multiplied by these losses, is what we call as the expected loss. So expected shortfall is very difficult to communicate, right? It's not that easy to explain or communicate to the management. So that is where the problem comes up. So the interpretation aspect of it, when do I say it is high, when do I say it is low, these kind of things are probably comparison with the target for a bank. All these things become more and more difficult with respect to the expected shortfall. Then similarly, when we are talking about a spectral risk measure, it's more